the huge question that honestly there's no answer to right now. Unfortunately, they don't know. It's very scary.
The Bank of Canada has shocked the market yet again with a 75 basis point increase. So, who is this going to hurt, and how is this going to affect our housing market? Thanks so much for tuning in again. If you really like this content, please support the channel by subscribing and hit that little bell if you'd like to get notified every time I put out a new video. If you have any questions about real estate, please feel free to click on the link in the description below that will connect you right to my calendar, where you can book a time that is most convenient for you for us to have a quick 15-minute chat, or feel free to just send me any question you have to adam@visionrealestate.ca and I will get you a personal response within 24 hours. Okay, so here we go. We got another big bump in the interest rate. So who is this going to affect immediately right now? Let's take a second and rewind the clock back to 2021, where we have a raging real estate market. Money is extremely cheap and prices are going up so fast that people simply can't keep up. If you're a bank, what are you hearing? Well, you're hearing from your customers that they'd love to get a mortgage from you, but prices are going up so quickly and they're really scared that their cash flow is going to be affected negatively if interest rates go up. So what did the banks do? Well, it was actually quite clever at the time. They figured, well, we can give you a static payment with a variable interest rate. We could just adjust the ratio of whatever you're paying monthly to be heavier on the interest and less on the principal. Now, for those of you who just thought what I said was kind of gobbledygook, I don't blame you. So let's just take a very simple example. Let's say you were taking out a mortgage for $500,000 to buy a piece of property, and your payment on that at the time was going to be $2,000 based on the variable rates that they had almost a year ago. Typically, the distribution would be half of that is interest and half of that is principal payment. But with prices being so aggressive and the market shooting up so quickly, the bank said to their customers, we will offer you a static payment. So even if rates go up, we will just adjust the ratio. We will still keep you at a $2,000 payment, but instead of half going to interest, half going to principal, maybe 70% will go to interest and 30% will go to principal. And it'll just adjust along with the interest rate. A lot of people, especially first-time buyers, thought that this was a great idea, and it became a very popular financial product for people to get into the housing market with. It gave them some assurance because realistically, their income isn't fluctuating up and down along with the interest rates. So you need some comfort in understanding that your cash flow is going to remain stable with your income. But if variable rates go up, then you're still protected, or at least have somewhat of a cushion. The thing is, nobody expected rates to go up by this much, this quickly. And so a lot of people are starting to hit what's called their trigger point, the point at which their static payment doesn't even cover all of the interest they're being charged. A couple of different things can happen in this situation, and none of them are really good. Here to talk about this with me is Jeff Mudrick, yet again, a mortgage specialist in the area that I work in. Let's hear his thoughts on this latest interest rate bump and what we can expect moving forward. Give us a quick breakdown. What is going on?
Sounds good. So yeah, as you mentioned, Bank of Canada, we meet on a semi-monthly basis now pretty much to talk about the Bank of Canada increasing rates for the past 6, 7, 8 months. So essentially, yes, Bank of Canada has increased the overnight lending rate by 0.75%, meaning anyone with a variable rate or with an adjustable rate mortgage, an ARM, they're going to see their mortgage payments increase by about $36 for every $100,000 that they owe on their mortgage. So if you have a $500,000 mortgage, who's going to do quick math? It's going to be around like 160, 180 bucks increase on your mortgage. They're doing this to combat inflation. I know you and I have had a lot of conversations about this. They're doing this to combat inflation. Many of the big 5 banks have mentioned they're predicting this to be the last increase of the year. However, no one's really predicted what's been going on the past 6 months to happen. So anyways, that's where we are today.
A number of my clients now who are hitting their trigger point. This is becoming more and more of a headline in the news these days as interest rates are going up. Can you quickly explain to everybody what are trigger points? When they hit them, what happens? And I know that different banks have different policies on this. So what is a trigger point?
All right, so a trigger point, or the time that when your rate gets, or when your mortgage gets triggered, essentially what that means is somebody has what's kind of like a static variable payment. It's technically called a variable rate mortgage. People aren't as familiar. There's two types of variable rate mortgages. Anyways, when somebody has a static variable rate, when interest rates increase or decrease like we saw today, that does not affect their monthly payment. Their monthly payment will remain the exact same. The only difference is that more of their monthly payment is going to go towards interest and now less towards principal because we saw a rate hike. So what happens when it was the trigger rate, because your monthly payments don't actually fluctuate, there comes a point over the past year where interest rates have risen to a point where your monthly static payment does not cover the interest portion of the mortgage anymore. So when that happens, there's a couple of big banks that offer this type of mortgage. And when that happens, there's a few different options, unfortunately, that is out of our control, that is on the lender. So some lenders are requesting clients to increase their minimum monthly payment to cover at least the interest portion of the mortgage. Other lenders are saying, hey, we're just going to extend your amortization, which really is not in the best interest of the borrower, because what that means is, hey, if you have a 30-year amortization, and now if you look on your online portal, it's going to show you like 40 years, 42 years, 45 years, something like that. And really, that you're essentially doing an interest-only mortgage, and it's not too beneficial to most clients, especially first-time home buyers.
I guess it's similar to a HELOC, but in that sense,
the exact same.
Yeah. So what ends up happening, from what I'm understanding, is the bank looks at this issue, which on a micro level doesn't concern me. On a macro level, it does. Is they're saying, well, the issue of you not being able to afford your debt, our solution is to pile that on as more debt, which means that now your loan to value ratio will change. My question is, and we're not there yet, so we don't know. And I don't know if this has ever really happened before, so we don't really know because these products, financial products, are rather new, is to what threshold are they okay with this new loan to value ratio?
So that is the huge question that honestly there's no answer to right now. Unfortunately, they don't know. So, or I do not know the answer to that. It's very scary. Like, I've heard rumblings that they're going to ask everyone who reached their trigger point to increase their payment by at least 10%. This kind of stuff all over the place right now being thrown at the wall. When I get more information, we'll have to do an update video on these trigger rates, because they were a hugely popular product for the last year when we knew interest rates would rise. But they want their first-time home buyers love their payments to stay the same. So I will we'll have to do an update video on this.
Okay, well, that's kind of a cliffhanger, to be pretty honest here, because that's a big question. Is at what point is the bank uncomfortable with the LTV changing, and if they're just tacking it on endlessly to principal, it's eventually gets to a point where there's no more down payment to cover that, right? So it gets a little scary, and I can understand how that we got here, but it's a little bit concerning. But thanks so much for taking the time to explain exactly what's happening. And yeah, we'll definitely have a follow-up real soon.
Appreciate it, Adam. And we'll talk soon.
I know I left you on a bit of a cliffhanger there with Jeff, but be sure we will definitely be doing some follow-up videos to talk about what we can expect moving forward. If you like this video, please hit that like button, and I will see you next time.